Did you know that even a recognizable and profitable brand like Toys R Us, generating revenues and a positive income, ultimately faced bankruptcy due to liquidity issues? Despite profitability, their significant debt burden from a 2005 leveraged buyout consistently drained their cash flow, culminating in their 2017 bankruptcy filing. Hence, it is very important to keep in mind liquidity. This measures the company's ability to pay its short-term obligations with cash or current assets. The three key liquidity measures are cash ratio, quick ratio, and current ratio. The cash ratio is a conservative liquidity ratio that measures a company's ability to pay off its short-term liabilities using only its most liquid assets, cash and cash equivalents. It is calculated by dividing cash and equivalents to current liabilities. While there is no universal standard amount of these ratios, general guidelines and industry practices provide the following range. For cash ratio, 0.5 times is considered as an acceptable range. However, keep in mind that these guidelines could vary with each industry. For example, retail and manufacturing industries are more likely to be less than 0.5 times, due to predictable cash flows and inventory management. Meanwhile, for technology or software firms, they might hold more cash, resulting to ratios more than 0.5 times. Next, quick ratio, also known as the acid test ratio, is a tighter measure of liquidity than the current ratio but not as strict as the cash ratio. It excludes inventory due to the following reasons. First, inventory often takes time to sell. Second, the value of inventory can fluctuate. Some items might become obsolete or unsellable, especially in industries like tech or fashion, and it is risky as buyers may not be readily available. Hence, quick ratio is calculated as the sum of cash and accounts receivable, divided by current liabilities. As a rule of thumb, 1.0 times is considered generally acceptable for quick ratios. Lastly, current ratio is a widely used liquidity metric that measures a company's ability to pay its short-term obligations with its current assets. It is simply calculated by dividing current assets to current liabilities, with 2.0 times as the benchmark for healthy liquidity. It is also important to take note on the impact of some changes in the current assets. In general, an increase in current assets, while keeping current liabilities the same, will improve liquidity. However, the increase in some items in the current assets can impact these ratios differently. When cash and accounts receivable increase, there will be an increase in cash, quick, and current ratio. While an increase in inventory will only improve current ratio, but will not impact quick and cash ratio. Here are the key takeaways. Changes in some items in the current assets can impact these ratios differently, hence it is not recommendable to use only one ratio. Liquidity is best analyzed alongside other liquidity ratios. While low ratios may indicate weak liquidity, higher ratios may also suggest underutilization of assets or not using its current assets efficiently. Low quick ratios aren't necessarily bad in industries with predictable cash flows or high inventory turnover. Having ratios below these amounts isn't always a red flag. However, if you're planning to take out a loan, it is vital to diligently monitor and improve these liquidity measures to enhance your prospects of loan approval. Lastly, if you're benchmarking or comparing liquidity ratios between companies, it should be industry-specific and company size-specific. Thank you for watching. Hope you found this explanation of the key liquidity measures insightful. Like and subscribe for more essential business finance tips.